Hello, this is David. Welcome to a brief video review of Chapter 1, a helicopter review from the textbook, The Essentials of Risk Management, 2nd edition. And I will warn you, this is a text-heavy chapter and review. There's really no calculations, but this is the first reading that's assigned in Topic 1, Part 1 of the FRM. So this is really the introduction to the whole syllabus. And in that sense, it really is superficial. But it does start with the definition of risk, or specifically, the first aim or learning outcome in the syllabus is explain the concept of risk. And so we always follow the assigned authors, and here we see that risk is the variability of adverse, unexpected outcomes. And then we can say more specifically, or in the case of financial risk, that it's volatility. So volatility, we can look at volatility as a special case of variability. Wouldn't be the other way around. Volatility is variability, but variability is not necessarily volatility. But it's of unexpected losses. So that's the key word here, unexpected losses. Notice, this definition implies that risk is not expected losses. It's about the potential for unexpected losses. And here's another key point. Even if the uncertainty has not been quantified or has yet to be quantified, the uncertainty still qualifies as risk. So there is that Knightian distinction between uncertainty and risk, where risk is what we can measure and quantify, and in many senses, the risk measurement is about the translation of uncertainty that has not been quantified into measurable risk, but we do include uncertainty as risk, because certainly unquantified risks, just because we haven't been able to quantify them yet, does not mean that they cannot pose great catastrophic threats to us. Just a couple of other semantic or definitional points here. These are actually not in the reading, but I'm just inserting them. That we are studying risk, and technically speaking, that's different than a peril or a hazard. The peril is the cause of a loss, and the hazard is a condition that increases the probability of a loss. As opposed to risk, there's the variability of an unexpected loss or adverse outcome. Let me get that correct. Risk is not synonymous with the size of a cost or of a loss, because some costs are large, but they are not a threat because they are reasonably predictable. So here, a case just on a personal level would be the case of a mortgage payment. That's a significant cost every month, but it's very predictable, so we wouldn't call that a risk. The real risks is when costs rise unexpectedly. And then also here, I have some concept from previous reading that introduced the syllabus, just to show you, just to note the consistency. The FRM churns quite a bit, but here is the same idea from the previous reading that has been replaced by the Crouhy textbook, where those authors had said that risk is the potential for the occurrence of a loss, but it cannot be separated from growth opportunities. And they also referenced the Chinese symbol for crisis because it includes both threat or danger and opportunity. And so there was a thematic point that's always been thematic in Topic 1, that risk is not something we ever want to eliminate, because risk is a necessary but not sufficient condition for growth or excess returns. And so excess returns requires risk taking. And in that sense, shareholders of a public company are not looking for riskless investments. They have alternatives. They can stay in cash if they want. When they go to invest in non-cash asset classes or public companies, for example, or private companies for that matter, they are assuming risk. And also the authors make the point that risk is, as an unexpected loss, underpins two concepts that are explored in the FRM syllabus. Value at risk is the statistical measure, and that defines a particular level of loss in terms of its chances of occurrence. And the other one is economic capital, that is mostly located in topic 7, that's part 2 of the FRM, but is introduced in part 1. Value at risk, on the other hand, appears throughout. So we're asked to describe the risk management process, and as a generic frame, this is also consistent. We start by identifying the risk exposures and then attempting to measure the exposures. So notice right here, I could argue that this is about, okay, what are we uncertain about that poses a threat? How can we translate that into some risk which is measurable at the same time that we're identifying the instruments? And then we're assessing the effects of exposure, and here is that classic cost benefit. And then, so this here, you can see this inference that we can measure the risk and do cost benefit sort of analysis and quantify that. We're then in position to form a risk mitigation strategy and make a decision what to do with each risk. Do we avoid it? Do we transfer it? Do we mitigate? Or do we just keep it? And always part of it is an ongoing plan, process to evaluate the performance of that. So it's not a risk management is not static, it's dynamic. The authors do reference several challenges with that sort of that theoretical elegance. A lot of what's emerging in risk is theoretically elegant but difficult to do in practice. So we do have a challenge on the author site of how do we manage unexpected levels of variability, and the reminder that risk management is not the process of reducing expected losses. It is the process of managing the unexpected levels of variability. Okay, so in here on out, I'm not going to read all of the text that appears in the slides. I think the slides are good flashcards and references, but a lot of the text that's on this slide is too philosophical for us to be relevant from a testable perspective, in my opinion. But we do just want to capture the high-level concepts. So next challenge that's specifically articulated by the authors is correlation risk. And this has gotten a lot more attention since the credit crisis, which is now several years old. But just to recur first to the fact that whole classes of risk factors can move together. And they operationalize that in the instance of real estate linked loans, where the loans may be secured by real estate collateral, but that collateral is losing value at the same time that the probability of default or default rate is increasing. And so this is operating on both the probability of default and loss given default variables and increasing the overall risk, so they act together. That correlation risk is wrong way risk. Another challenge has been that since the crisis, risk managers have, and the authors would say here, appropriately moved away from or generally shifting away from an over-dependence on historical statistical treatments of risk. Part of the attraction of that is that historical statistical approaches are quantifiable, and so sometimes the numbers can be seductive and deceptively easy to work with. But the authors argue that there has been a shift toward scenario analysis and stress testing, and these are not entirely, although there's a strong quantitative element, these involve some judgment, some subjectivity, sometimes, or these are not activities that a single person does in front of a spreadsheet, so it gets into collaboration and human factors. So in all, in some ways, more difficult to pull off some of these, but it's become necessary that scenario analysis and stress testing have been incorporated into the management of risk. And there's a point here that scenarios are the selected scenarios tend to be both plausible and suitably severe. Okay, there's a bit in the reading about a risk manager's job. And the authors say that the role of the risk manager is to uncover the sources of risk and make them visible to key decision makers and stakeholders in terms of probability. So, and a sub point of that is that it's not the risk manager's job to produce a single point estimate of the risk. And here there's just an example of an exchange rate, but that's not really the point. So this is a classic idea in finance going back through several of the authors, including Jorian. The idea that risk is different than valuation. Valuation is concerned with accuracy in the estimate. We would like to figure out how much is this instrument, this asset, this portfolio, this company worth. The risk manager does not pretend that he or she is dealing in accuracy because this risk is necessarily projection into some future outcomes that are uncertain. And so the risk manager really by default assumes a distribution, or this is just a range as opposed to a point estimate. So, and that is not accuracy. We're generally not under the burden of trying to be precise or accurate with the loss estimates. Also, the risk manager's role is not to be just defensive. The firms are balancing risk and reward, and so the risk manager is trying to gain a seat at the table with the leadership and with the and as an ally to business unit heads to try and frame, not only manage risk in a defensive manner, but help the firm approach risk proactively, offensively, in other words, in support of growth. There is a point here about up and downs in the risk management historically, but I'm not going to go into detail on the video review because really these are not going to be relevant to us either on the exam or in the subsequent syllabus. Just to point out that there's been an uneven history in risk management, some downs and some ups, and clearly the financial crisis represented for many in risk management a sort of failure or admission that there needed to be some improvements. But there's also at the same time been some real successes. There's a learning outcome that asks us to evaluate and apply tools and procedures used to measure and manage risk, including quantitative measures, qualitative assessments, and ERM. So that's just an introduction here to the three ideas: quantitative, qualitative, and enterprise risk management. What do those mean? Well, qualitatively, the authors here just introduced the idea that one approach is for us to just develop the typology when we're not, when something's a challenge to deal with. One approach is to start to break it up into pieces and define it. And so this is a classic approach to risk, dividing it up into broad risk categories. I tend to call these three buckets because this portends what's coming in Basel, and Basel's three major risk buckets: market, credit, operational. And these happen to be sequenced here sort of in the order that the technologies evolved. So market risk is arguably, or I would argue, the oldest risk that's got the most theory behind it. And then came credit risk. And then we could debate those two. That's just my opinion. But I don't think there'd be much debate that operational risk was the newest, youngest sort of science. But that general point here is that's part of the qualitative approach, is to divide and define the risks into categories. And now each of these get granular, and then and as time's gone by, each of them has gotten progressively more granular. And the authors just make the point that these classification schemes, or what I call typologies, are valuable but also dangerous because just we've named it doesn't mean we really understand it. And it also promotes the creation of silos of expertise. So we think of them because we have market versus operational risk, then we may have someone who specializes in one or the other, and we're already then arguably promoting silo type thinking. And the authors say that some of the most recent advantages in risk management are really attempts to break down this natural organizational tendency towards silos. which introduces the ERM, which is mentioned in the learning outcome. And this reading is by no means a deep review of the broad topic of ERM and controversial, but just teases us with the notion, if we want to ask, what is enterprise risk management? These authors would probably say what it really is just an attempt first to break through the different silos. I would think of it maybe as taking a horizontal view of the organization as opposed to a vertical view in the functions. But it's an ability to talk about risk in a holistic way rather than just be limited by a vertical function. And they also make a point that ERM blurs the distinction between risk management tools and capital management tools. So the three ideas there just in this learning outcome were qualitative approaches, enterprise risk management, and then quantitative measures. And so clearly we have a lot of many quantitative measures to explore, but there's just a warning here that just because that numbers can be dangerous as well. While assigning numbers to risk is incredibly useful, it's also dangerous. Only some kinds of numbers are truly comparable, but all kinds of numbers tempt us to make comparisons. So I think this is a really interesting, relevant point, just because we've quantified different risk types. The numbers themselves make us think that we can compare them, but that's not always the case. And their example here is the classic example of a notional amount of a bond. So we can have a $1 million position in a par value 10-year Treasury bond. That could be a view on the notional amount, $10 million notional or par value, but that's not going to be comparable in risk to another bond where we also have $1 million notional exposure. So there's an instance where the numbers may be identical, but they're not comparable from a risk perspective. And so then we can become more specific and move beyond notional, and we surely do. But clearly that introduces its own problems. There are plenty of critics here who would cite that, okay, we get more sophisticated measures, but then we really introduce model risk, and we get seduced by the sophistication into thinking that just because we have a very specific number, we've accurately quantified the risk. Value at risk depends on a robust control environment. And then I'll just go to the next aim, distinguish between expected loss and unexpected loss and provide examples of each. Why does that appear here in the introduction? Well, my best guess is it's just to remind us that we're dealing with, when we talk about risk, unexpected losses, not expected losses. The authors give us the classic example here, which I think is very good, the expected loss for a credit card portfolio. If you think about that, anyone who owns that portfolio does expect some defaults, not to mention fraud. And so we can't say that expected loss is zero here, really for any credit portfolio. So there is an expected loss, and in fact, the larger that is, the more diversified that is, the more predictable those expected losses are, and it's a cost of doing business typically priced into the products. And so expected loss, we need to be aware of that variable, but it's the unexpected loss that really challenges us in terms of measurement. And so contrast the credit card portfolio with a corporate loan portfolio, which tends to be much lumpier. And there, the authors argue that it's much more apparent that in some years the losses spike upward to unexpected levels. And so unexpected loss plays a much larger role in the lumpier portfolio than it would in this large, well-diversified credit card portfolio. There's a learning outcome there that asks us to interpret the relationship between risk and reward. This is explored further in topic 1 as well, in particular with the capital asset pricing model, because that's the sort of most traditional model that gives quantification in theory to the risk-reward relationship, albeit classical and with and imperfectly, but it does sort of quantify, it does really quantify this idea that risk is necessary for reward. And there's the traditional view, of course, would be that for greater reward, I would operationalize that with for greater excess returns, that is returns above the risk-free rate, we should expect to incur greater risk. Notice both of those words, I would hope that you hear both of those words if you're new to risk and ask for further definition, because both sides of this have many ways to further define that. When we say, even when I say excess returns, I have a lot more that I need to say to be specific about what I mean. And certainly when I say incur greater risk, I have a lot more that I need to say before I've been specific. Okay, but that's the classical view, and it has detractors for sure, but the authors make the point also that in the case of risks that are not associated with market-traded financial instruments, there is a problem of transparency. And so here we can be thinking especially about highly illiquid markets, where that relationship between risk and reward is not obvious, or as the authors would say, much more profound. Okay, so moving on to the final section of this reading then, there's a mouthful here of asking us to describe and differentiate between the key classes of risk, explain how each type of risk can arise, and assess the potential impact of each type of risk on an organization. And what I will say first is that this is just the typology that's illustrated by these authors. There is no single necessary typology for risks. Even GARP, currently to my knowledge, doesn't sort of promulgate a single typology. What we tend to do is rely on the Basel II, Basel III regulations, as we tend to borrow their model. But it's just to say that it's not the only model or classification system. These authors didn't really quite stick to it, because really they start in the appendix just by itemizing all of the, or most of the major risk buckets, if you like. Market, credit, operational risk, those are the three big buckets. And then notice liquidity risk is at the top, on a sort of top level as sibling to the other risks. But that's not the only way to do that. Liquidity can be a subclass of market risk. And then they've also got legal and regulatory risks, obviously significant risk, but legal risk is a subclass of operational risk in Basel. So specifically, it's one of Basel's 7 event types under operational risk. So we tend to follow that and consider legal risk to be a subclass of operational risk, but we don't get too obsessed about it. And then also itemized as well here, business, strategy, and reputation risk. And so these, I've got these, I highlight these just to pull them out of operational risk, because these are all top level, according to these authors, but legal, if I were to do this, I'd put legal under operational risk, and I would specifically identify business and business, strategic, and reputation as not part of operational risk, which is they're not here as well. But I would distinguish between business and non-business risks and financial and non-financial risks. So those two frames would inform the division, but that's not here. These are all top level, and they're also not exhaustive. But it's just to make a small point here that it's fine to say, consider, I'd recommend that you think of legal as a subclass of operational, and I would recommend that you think of these three, business, strategic, and reputational risks, as specifically not part of operational risk, or what we're really studying, which is operational risk as a type of financial risk, and that is not these three. Okay, enough on that. Here's the diagram. Just I redrew this from the appendix where the authors parsed that financial risk into market and credit risk. So that's two of those top level risks that we just looked at. And then notice we've got further parsing here. This follows the Basel right here, market risk into 4 components, the interest rate further into trading and gap, and that trading risk into general versus specific. Do you need to memorize this? I would say no, because you're going to get familiar with most of it anyway, just sort of without, but not necessarily in the frame of that typology. So I won't go too deeply into some of these concepts because they get reviewed and specifically. Certainly market risk will. I would just note here that to agree with the authors that it's given different names in different contexts, and I do like that they've highlighted basis risk. I have a video on YouTube where I call basis risk the mother of all risks, because anytime you go to hedge an exposure, you necessarily are exposed to basis risk. I feel like I can demonstrate that regardless. Basis risk is very real, and so I'm glad that they included that. Then there are 4 major types of market risk, and this does follow Basel: interest rate, equity, price risk, foreign exchange, and commodity. And then a further dive down, I'll just note for us on the video here at this point that the simplest form of interest rate risk is the risk that the value of a fixed income security, so think bond, will fall as a result of an increase in market interest rates. So that would be a long position, or if we've purchased a bond, we're exposed to an increase in market risk. Of course, we can take a short position and we'd be exposed to a decrease in market rates. We have equity price risk, and notice we're consistent with that definition that we started with, that the risk associated with volatility in the stock price. And then this gets parsed into general and specific. And so note the synonyms there. Specific in the CAPM literature is also called idiosyncratic risk. And here's our summary of portfolio theory. You could do worse for a summary of the entire set of theory. General market risk cannot be eliminated through portfolio diversification. It's the specific risk that can be diversified. I like that as a summary by that way of portfolio theory, mean variance framework, capital asset pricing. The idea that I just break them into two steps. First step is that one of the few free lunches we have in finance is diversification. And classically, what does diversification gets us? It gets us the reduction and really the almost elimination of a very particular kind of risk, that is specific risk. Then we have more exchange risk. I won't go into that. We've got an entire Sanders reading devoted to that. Commodity price risk. Credit risk, also well covered in the syllabus, and it's always being updated. So I feel like the FRM does a good job of keeping us current on credit risk, maybe with the exception of we do need a new reading on ratings, external ratings. But notice that this credit risk is further divided. So I think that's worth noting that credit risk has become has for a long time been a very broad bucket that we further we can be much more specific about what we mean. They don't include, for example, here migration risk, but that could be a synonym for downgrade risk. The idea that our bond doesn't need to default necessarily for it to lose value. It can downgrade or just lose its credit quality. So there's a lot of risks before we default. And they do make a note here of credit events that are formalized in the ISDA documentation. So a credit event can include bankruptcy, cross default, acceleration, a fall in the underlying asset price, downgrade, restructuring, which is controversial, and repudiation. Liquidity risk is much more popular since the credit crisis, and notice that parses into two as well: funding risk and trading liquidity risk. Funding liquidity risk is a balance sheet perspective. That's the question of whether the firm has the funds necessary to cover debt obligations. So it's really about liabilities on the balance sheet as opposed to trading liquidity risk. And that's the risk that when we go to sell, we're not going to get the best possible price due to if we don't have perfect liquidity. And so bid-ask spread is a popular measure of that type of liquidity. Operational risk, as you know, there's a whole topic in part 2, topic 7, devoted to operational risk. So I won't go into detail that here, and I'm not sure that there's much here that necessarily a part 1 candidate needs to memorize. Legal and regulatory risk, at least at this superficial level, and business risk, and then strategy and reputational risk. We will make a note here that reputational risk is parsed into 2 classes. First is the belief that the enterprise can or will fulfill its promises to counterparties. And the second is more of an ethical perspective, the question of whether the enterprise is a fair dealer and follows ethical practices. So we're still itemizing risks from the appendix, and we have systematic risk, a very hot topic since the crisis. So in recent years, this has been showing up in current issues, topic 9 of the FRM. And the authors note that the Dodd-Frank Act focuses on addressing systemic risk, among other things, by establishing the Financial Stability Oversight Council. And also an important feature, the decision to move a range of the over-the-counter derivatives onto centralized clearing or exchange-traded platforms. And so that really concludes a summary review of that first reading, which introduces topic 1 to the FRM candidates. I hope you enjoyed that. Thanks.